This video contains synthetic content which has been approved by Rick Kimberley and RSM Australia. Now we have covered that, happy new financial year everyone. My team and I have survived the FBT season, and whilst we are getting stuck into payroll tax, we wanted to provide you with a summary of the key employment tax and expatriate tax matters during May and June 2025. Let's jump right in. We saw an interesting case relating to travel and whether or not certain travel expenses should be considered private in nature, and whether a various allowances provided would qualify as a travel allowance, and therefore be potentially eligible for the substantiation exception permitted in Section 930 of the ITAA 97. In CBRX and FCT, an individual employed by a major oil and gas company worked on a remote offshore facility off the coast of Western Australia while residing in Queensland. His employment operated on a rotating roster, 3 weeks on and 4 to 5 days off, officially commencing and concluding at the offshore site. In the 2022 income year, he claimed over $30,000 in travel-related expenses, including costs for travel between Broome and Perth, quarantine in Darwin, and time spent in Perth for training and supporting activities. In making these claims, the taxpayer tried to rely on the Commissioner's substantiation exemption permitted for bona fide travel allowances. The taxpayer received an offshore allowance, a commuting allowance, and a secondment allowance. In relation to the allowances, the Administrative Review Tribunal, ART, determined that none of the allowances paid should be deemed travel allowances. The ART determined that the commuting allowance was designed to cover some of the costs borne by the applicant in travelling from home to the designated Australian airport, and was not intended to cover any costs from Brisbane to Broome or onwards from there. This travel was clearly private. The offshore allowance was paid to recognise and compensate for the challenges of working remotely, including family separation, discomfort, time travelling, and the loss of normal rest days and public holidays. Accordingly, it was not paid for travel taken in the course of the applicant's duties as an employee. Finally, the secondment allowance related to the applicant undertaking 12 days quarantine in off-duty time. As it related to a period not working, it too could not be deemed a travel allowance. In conclusion, the tribunal determined that the work-related travel expenses were not incurred by the applicant in the course of gaining or producing his assessable income. They were incurred when he was off duty and therefore on leave between rotating cycles on the facility. Further, the applicant did not receive a travel allowance as defined in the ITAA 97 Act. Another case, which requires consideration of whether travel is work-related or personal, came in Hall versus FCT, where a taxpayer who was required to work partly from home because of COVID restrictions was entitled to deductions for home office expenses and also for car expenses travelling between two workplaces. The taxpayer was employed by ABC in Melbourne as a sports presenter. He had both a live and digital role. During COVID, he performed his digital role in his spare bedroom. He performed his live role at ABC's South Bank Studios, which was 8 kilometres from his home. The ART allowed his deductions, noting the use of his second bedroom was a fixed part of his working life for the entire income year in question. The car expenses were also deductible on the grounds his travel was on work, as it was conducted on days where he worked on his digital duties at home first, and then drove to a second location to perform his live duties. Moving on to FBT. In FCT v Sepal, the federal court ruled that 3 brothers who controlled a family business through a discretionary trust were employees of the trustee company for FBT purposes. Although they did not receive formal salaries or have employment contracts, they were directors and beneficiaries of the trust and received non-cash benefits, specifically access to luxury motor vehicles from the trustee company between 2016 and 2020. The ATO assessed the trustee for FBT on these benefits, but the AAT initially found the brothers were not employees and the benefits were not taxable. The federal court overturned this decision, applying Section 1371 of the FBTAA to broaden the definition of an employee beyond common law concepts. It concluded that the benefits were provided in respect of the brothers' employment. The court emphasized that a sufficient or material relationship between the benefit and employment was enough to satisfy the statutory test. Moving on to electric cars, the ATO has released an updated version of its practical compliance guideline in relation to calculating electricity costs when a vehicle is charged at the employee's or an individual's home. The new PCG allows minimal compliance involvement by the ATO and contains a transitional approach, including a reasonable estimate where kilometres have not been maintained. The new draft PCG provides guidance in calculating the cost of a plug-in hybrid electrical vehicle, which the current PCG did not apply to. We saw an interesting individual tax residency case. In Evans and FCT, a fly-in, fly-out worker who spent most of the 2021 income year overseas because of COVID-related travel restrictions was deemed to be a tax resident of Australia during that year. The taxpayer was an Australian citizen who had a home in Perth. He had a partner and 3 dependent children and was a fly-in, fly-out worker who often spent at least half the income year working outside Australia. The ART concluded he was a tax resident of Australia during the 2021 income year under the Ordinary Concepts Test. The taxpayer's limited time in Australia in the 2021 income year, which was approximately 70 days in total, was only as a result of the COVID travel restrictions, and he maintained an intention to return to Australia when he was rostered off and when his employment in Botswana came to an end. Further, there was a continuity of connections to Australia, as demonstrated by his immediate family remaining in Australia, maintenance of his personal home, and other substantial assets. Moving on to payroll tax, the Victorian payroll tax threshold will increase from $900,000 to $1 million for annual returns from the 1st of July 2025. There will also be the phasing out of the threshold for every dollar of wages above $3 million. And business with Australian total taxable wages above $5 million will not receive any payroll tax-free threshold. The phase-out rate increases to 50% from the 2025-26 financial year onward. Additionally, the definition of regional employee for payroll tax purposes has been extended and clarified. The amendment clarifies that only services performed in Victoria will be taken into account when determining whether a person is a regional employee. This change is to be made on the basis that currently, some Victorian businesses were performing services mainly in other jurisdictions. The intention of the amendments is that only time spent performing services in Victoria is to be taken into account. There are also new reporting requirements in New South Wales around workforce details and employing general practitioner contractors. Employers must now report labour hire and employment agency payments separately from contractor payments. Contractor payments must still be categorised as liable or exempt, with any exemptions clearly noted. Eligible medical centres must also confirm whether they received the bulk billing rebate for GP contractors. From the 1st of July 2026, the Australian Capital Territory will implement a revised payroll tax framework, reducing the exemption threshold to $1.75 million. There are also several adjustments to the tax-free threshold and the rates to be mindful of. There were also new announcements in Queensland around payroll tax, including an exemption for general practitioners and an extension of the rebate for apprentices and trainees. In payroll tax case news, the NSW Civil and Administrative Tribunal handed down its decision in the matter of Nova Security Group v Chief Commissioner of State Revenue in favour of the taxpayer, finding it had not entered into employment agency contracts for the purposes of Section 37 of the Payroll Tax Act. The taxpayer entered into a number of contracts with clients, typically licensed venues and pubs, clubs, to provide security services. These services included crowd control, checking identification, searching bags and ensuring safety at the relevant venue. The taxpayer held a master security license in accordance with the Security Industry Act 1997, and with the exception of 2 clients, its clients did not hold a similar license. In order to perform the required services for its clients, the taxpayer primarily resourced these contracts through personnel obtained from subcontractors. The Chief Commissioner of State Revenue issued payroll tax assessments for the years ended the 30th of June 2019 to the 30th of June 2022 on the basis it had determined that these arrangements were employment agency contracts. The primary question in dispute was whether the security guards were working in and for the conduct of the taxpayer's clients, such that they would be viewed as being integrated or effectively added to the client's business. The tribunal determined that while the taxpayer procured security guards to perform services for its clients, the security guards were not integrated into the client's business, and as such, they were not procured to provide services in and for the conduct of those clients' businesses. On this basis, the tribunal determined that these arrangements were not employment agency contracts. Moving on to pay-as-you-go obligations. Starting the 1st of July 2025, the reporting rules for lump sum E back payments will change. Previously, only back payments exceeding $1,200 are reported as lump sum E. From July, this threshold will be removed, meaning all such back payments must be reported as lump sum E, regardless of the amount. Employers must also specify the financial year in which the payments accrued. These changes are part of STP2 compliance. It's essential that employers ensure their payroll software is updated to capture and report these amounts correctly. The ATO has released an exposure draft for the 2025 legislative instrument titled Taxation Administration, withholding variation for payment of certain allowances. This instrument is designed to modify pay-as-you-go withholding requirements for specific allowances, setting the withholding amount to nil where the allowances are expected to be fully deductible. It applies to payments related to car expenses, laundry expenses, domestic and overseas travel allowances, overtime meal allowances, and award transport payments. Once finalized, the new instrument will repeal and replace the 2015 version, which is due to sunset on the 1st of October 2025. The new instrument maintains the same effect as its predecessor, but updates the framework to reflect current conditions. Employers and payroll providers should review the draft to ensure readiness for implementation. This change is part of broader efforts to streamline withholding obligations and reduce unnecessary compliance burdens. A quick data matching update for your consideration. The Department of Home Affairs, including the Australian Border Force, has issued a notice that it will obtain data from the ATO to identify whether business sponsors are complying with their sponsorship obligations, for example, paying visa holders correctly, and whether temporary skilled visa holders are complying with their visa conditions. This will result in records shared of approximately 58,000 individuals. Similarly, we refer to our earlier notification in the year regarding the ATO's use of immigration records to identify individuals or employers that are not being compliant with their personal tax affairs or employment tax obligations. An interesting case we wanted to highlight: a long-standing tax ruling that prevents families from claiming childcare as a deductible work expense is being challenged in a test case brought by ABL. The law firm is running the case pro bono, representing several litigants from diverse family and employment backgrounds, to prompt Australia's highest court to revisit a decision made 5 decades ago. The law firm believes the childcare deductibility case shines a spotlight on outdated reasoning that continues to influence major aspects of tax law. The law firm are making the argument that having someone look after your child actually makes an employee more efficient, which they argue is what the deductibility principle should be based on. This last financial year has seen lots of developments in the employment tax and wage compliance space. Contractors and wage underpayments have continued to dominate headlines and case law updates as expected. Interestingly, we have seen a lot more content from the often forgotten FBT space. We saw a welcomed flurry of legislative instruments helping relieve employers of administrative burden and potential loss of concessional treatments due to missed declarations. We have seen an increase in employment tax audits by the ATO, which we anticipate will only increase over the next 12 months. Additionally, with only 12 months to go until the introduction of Payday Super, we are expecting a lot more calls from our clients to help ensure readiness to go live from the 1st of July 2026. Lastly, we look forward to continuing to bring you these updates in FY26. Thank you for joining us for our year-end employment tax update. If you have any questions or would like to discuss how these developments may affect your business, please don't hesitate to contact your local RSM Global Employer Services team, myself and Peter in Melbourne, Gina and Neve in Perth, or Jason in Sydney.